Hello, everyone. My name is Ben Driggs. I'm at Navigate Financial. Today is July 1st. We just finished the second quarter. We're halfway through the year. And I wanted to spend a few minutes talking about how we're doing so far this year, what happened in the second quarter, and also what might be in store for the rest of the year. So let's talk about what has happened so far this year. If we look at the first quarter, it was relatively tame, muted. The first couple of months started out well. Then we had the beginning of the war that pulled things back. We ended the first quarter roughly flat, maybe a little in the red. And then the second quarter, things just went crazy on the good side. So we ended the second quarter, this is yesterday, with stocks having a good run. Stocks maybe about doubled it, maybe hitting about 10% on average. International stocks a little better than domestic stocks, but roughly 10% on stocks. The bond market, on the other hand, is struggling with these inflationary pressures. Inflation and interest rates are the enemy to the bond market. So bonds are flat roughly year to date, and the cash markets are up, a couple percent so far this year. So if you have a moderate portfolio, you might be somewhere in the 5 to 10 range. If you're aggressive, you might be at about 10%. If you're conservative, you might be, 2 or 3%. So that's what we have so far this year. In terms of what the driving factors have been, is on the good side, what is driving things, we still have a lot of AI, microchip, infrastructure build out that is driving a lot of money into the markets for the long term. Literally trillions of dollars is coming into the market saying, hey, we are excited about the future of technology and the infrastructural needs. So we're going to invest in the long term. Prices are quite high. There's a lot of optimism around that. But that trade, those technology trades are very much in vogue these days. The jury's still out whether or not that's going to work out as planned. Clearly, there's a big demand for that, but are the prices starting to get too expensive? Only time will tell. But corporations are making lots of money. Profitability is very high. Technology is working in favor of corporations. Scale, we're having big companies buying out little companies. So the capital markets, the stock market, particularly in the United States in the second quarter, is alive and well. The economy is still hanging in there. Unemployment is relatively modest, and it's kind of hanging in there pretty steady. So those are positive things. The challenges that we have are, we do have this high inflation, interest rates are higher, and prices are starting to get too expensive for many people's tastes. So there are some concerns. So let's talk about what's ahead here in the next few months or till the end of the year. There's no reason why the stock market could not continue to do well. The companies are making lots of money. The economy is in decent shape. Again, unemployment is holding steady. So I think that makes, I certainly don't think the third quarter is going to be as good as the second quarter, but there is reason for some confidence heading into the third quarter. On the skeptical side, we've got a consumer that is burnt out with inflation. It's just been going on now for several years. People are really getting tapped out. They're stretched thin. We have record consumer debt right now. And so this is putting a lot of pressure. There's questions about at what point and how AI starts to take jobs. Right now, that hasn't really happened in significant numbers, but there is concern that that might start to happen. And if so, then we start having unemployment. The consumers might start feeling a little fatigue and concern. We have the elections coming up, and that might cast some concerns about political stability and what's going to happen with the future on the political front. But I think the big thing is inflation. There's some inflation fatigue. Interest rates are moving up, not down. When we came into the year, we thought interest rates, inflation would start taming. That's going in the opposite direction. That's going to put pressure on borrowers, particularly those who have debt. It's certainly holding off on home building and new home purchases for would-be homeowners. So these things do slow the economy down, and I don't think it is time to be like go go go. We're 3.5 years into the bull market. That's a pretty long time for a bull market, and so it would not be unreasonable to think that there's going to be things are going to start to slow down. But at any rate, I think it's stay the course at this point. Call us. That wraps up my commentary. Please give us a call if you have any questions. For those of you who are clients, I have typed up a summary that you'll be receiving here later on this morning. So we appreciate your business. We appreciate your spending a few minutes listening to this market commentary, and we'll see you around. Happy 4th of July. Take care.